Drawing ever more resources from a planet that has a finite supply of them is one of the fundamental challenges of facing continued economic development. Now, the stewards of global capital are becoming aware that steps have to be taken that's to ensure that investment returns and the businesses underlying them have a sustainable path to ongoing growth. Now, here to explain why responsible investing is so important, Tracey Want, Head of Strategic Marketing at Investment Solutions. Tracey, thank you so much for joining us. Of course, a very important topic when it comes to the future of asset management. First up, just explain to us the difference between responsible investing and socially responsible investing. Of course, that would be SRI.
I think it's a definition that often gets kind of used intertwined. And I think that there's a lot of particularly institutional investors that really struggle to understand what the difference is. But really, from my perspective, I see it as a socially responsible fund, or an SRI fund is typically a fund that would invest in projects that would benefit a community in which it could have to do with some form of infrastructure development, such as hospitals, shopping centres. It's a couple of very good asset managers that sort of play in that niche market. So they look for opportunities that have a good financial argument as to how good the results will be, but the actual benefit would be to the community. From like an ESG or full responsible investing type
ESG, just for the viewers, is environmental, social and governance, because we use that in kind of jargon all the time these days.
Absolutely. So you've got ESG, SRI, RI, those are the sort of three terms that are being bandied about. So RI refers to responsible investing, and RI sort of looks at intentional integration of environmental, social and governance factors, ESG, into an investment process. So RI refers more to a complete process, whereas your SRI type funds refer to, it's almost like an outcome. It's to say that I invest in this and the outcome is I benefit the community in which the project is based, as well as earning a financial return. Responsible investing refers to the actual investment process and the decision making and the ownership responsibilities that go with owning a stock.
Tracey, just to really draw this down in terms of the real importance to investors, I mean, we've seen something that's happened very tragically recently is at Marikana. You know, we talk about the social responsible investing, and it's sometimes a concept that's very warm and fuzzy and no one knows quite what to do with it. So let's really translate it into what it means for investors. When we looked at Marikana and we saw part of the situation that led to Marikana was the living conditions of some of the miners. Is that something that would be addressed by responsible investing? Is that something that you would encourage your investment managers to look at when investing in companies, to see how they look after perhaps the living standards of their workers, for instance?
Yeah. Do you know, what happened at Marikana was a tragedy, and I think nobody could have foreseen it. And that's a problem with ESG issues. When you try and assess them, there's no financial ramification or a financial result that you can kind of attach to it. So you can't say,
okay, you're going to have the mine shut for 2 weeks, you're going to lose that amount of ounces.
Exactly.
I mean, there's uncertain issues.
Exactly.
Around it.
So you look at these issues and you kind of say, well, when will they play off? But the issue with ESG is more around assessing factors that aren't necessarily traditional financial indicators. So what you could have done when assessing the company is to compare the living standards of the miners, you know, and the sort of previous grievances that were raised by the miners. And there were sort of other indicators or early indicators that may have highlighted certain risks that could have been factored into the buying decision of Marikana or the engagement decisions around that. And you know, often how asset managers would make their decisions is they would do a bottom-up analysis. So they would look at a stock and say, well, they think it's worth X. And they'd value, and you know, they're all financially minded people, so they would value it using numbers and formulas, and they'd come up with a price that they would believe that the stock would look attractive at. And then they'd factor in other forms of risks, and often how a lot of asset managers would factor in these ESG considerations is they'd start evaluating them and really look to see, are there any sort of negative or potential negative implications of these sort of non-financial indicators. But when it's going to play off and what that actual value would be is very difficult. And that's why it's so hard for asset managers to really firmly incorporate these into their investment decision-making process, because there's no number that you can just assign to it, and that's the difficulty right now. What some asset managers are also talking to is the availability of information in South Africa. You know, we have sustainable or integrated reporting standards. Certain companies or listed companies have to report on their sustainability type initiatives, but it's still very much in my opinion, a marketing document. Companies decide what they want to disclose, and they try and follow sort of broader guidelines, but asset managers are using that information to make decisions on. And I think that's one thing that in South Africa we're still far from, is to really try and get good, solid, audited ESG information available to our asset managers to make decisions.
I think one of the things that if I'm understanding you correctly, is that while the ESG factors may not play into the actual financial valuations and the models that the analysts and portfolio managers are using, it's certainly a way of identifying risk though. And we talk about governance as being one of the key things. We've seen certain things happening with the likes of WorldCom, where you've had funny things happening at a governance level, perhaps not enough independent directors, or the constitution of the board is not independent enough. These are things that actually really make a difference in terms of risk. So from what I'm hearing from you, it's not just too much about being able to plug into something that might affect evaluation, but it's certainly a way of identifying risk.
Yeah. Some of the good asset managers that fully integrate this, and they integrate it because they believe there's a financial sort of reward to integrating these issues, they would look at it and they would actually discount. Some of them actually factor it into a discount model. So they would look at governance issues. And funny enough, governance is an interesting one, because when you speak to the asset managers that really incorporate this into their investment decision making, those asset managers sort of talk to governance as being the starting point. If you can't trust the governance of a company, how can you trust anything else that they do? So it would almost be, look at governance. If yes, then look at valuations and continue with the sort of investigating. So that's where governance does play a big role. But you'd be surprised, a lot of these managers do actually bring it into a financial metric by assigning some form of risk number or ranking table of sorts.
When it comes to ESG factors and incorporating them into your investment decisions, it is also not just a case of saying, okay, well, this company isn't ESG friendly, if you could call it that, so I'm not going to invest in it. The other option is to really become an active shareholder. Say, I want to invest in, for example, Lonmin, but I would like to be an active shareholder in the process and highlight the risks to management and hope to bring about change. And there you are, being a better corporate citizen, I suppose a citizen of a global citizen rather.
Yeah, I mean, at Investment Solutions we feel very strongly with that. We really feel that you shouldn't be excluding shares from your sort of toolbox. So you would want to have the biggest, best toolbox with the most robust tools to generate outperformance. So we would want our asset managers to really be thinking hard about the total South African universe to buy stocks. But then you're 100% right. It's firstly identifying the risks so that you know what you're in for, and doing the analysis around these issues that are sort of, and you can almost say non-traditional measures, to understanding what the potential sort of impact could be on the actual return of that stock. And then when they actually hold that shares, to start questioning these issues. It's managing really the sort of predictability of return streams from that asset.
But how prepared are investment managers, asset managers, to stick their necks out and talk about, the pollution of your mine right now and the impact that your mine has on the community around us? I mean, is that happening at all in South Africa?
I mean, we recently conducted a survey, and all indications are that asset managers are saying that they're voting and they're talking to and they're engaging. But it's difficult to really and truly assess, because when you talk to the asset managers, a lot of them tell you that they've had these sort of discussions sort of privately, and they've tried to influence engagement. And we know some of our big asset managers have brought environmental experts in to talk to the board and try and influence behavior in that way. But a really good example is an asset manager that we spoke to, international big asset manager. They really are massive. And they had an issue with a company, and it was also something that just didn't sit well with them, and they started engaging, and the directors were just completely dismissive of their requests. And literally what they eventually did was, when directors' remuneration came up for discussion, they actually sat with the director, one of the most influential directors concerned, and said, listen, we'll be voting against you if you don't start listening to us at least. And surprise, surprise, at the next meeting, the issue was raised, and they actually started moving in the right direction. So managers do have a lot of power, but it requires resources, and it requires having your finger on the button. And I think that's what's quite difficult in the South African manager landscape, is you see a lot of the asset managers giving their PMs the sort of that they kind of like play that role of influencer, engager, because they really are close to the companies. And I think in South Africa, because our universe is small, our South African managers are really good at that. But where it comes to actually, like you say, influencing and really shifting behavior. We struggle to see the evidence now, but I think that there is thought and kind of movement in that direction.
So I think what you're saying is when push comes to shove, we've been a little bit light. Some of the portfolio managers have perhaps not been as active as others. But I know we are making development, we're making progress. I've seen the likes of Regarding Capital Management actually putting the voting decisions on their website so their investors can see why they voted and what they voted for when it comes to some of these issues around the companies. In terms of the survey, obviously it's the first survey you've conducted, and I know we want to talk about this a little bit more. Perhaps in another show. But just in terms of asset managers now adopting this model, what's the framework for them? How can they go about, is there guidance being given to them in terms of what it means and how they can exert influence on the companies that they're investing in?
From an asset manager perspective, there's sort of two pieces of legislation out when you look at the institutional landscape. You've got Reg 28, Regulation 28, which pension funds are governed by, and within that there's sort of comment around trustees of big pension funds having to consider ESG factors when making their investment decisions. It's a very vague kind of statement. And then CRESA was released, which is the Code for Responsible Investing in South Africa, and that was released in February this year, and asset managers can voluntarily take up on this. Now, CRESA gives asset managers sort of general guidelines, but it talks to around disclosure and ownership responsibilities, but it's not very specific guidelines. And I think it was done purposefully. It was, you know, asset managers are good when they're different, if you know what I mean. So you don't want the whole of the South African asset management landscape to be thinking in the same direction and doing the same thing. So there's definitely an element of use your intellectual capital, make the best decisions, but disclose and tell the industry what you're doing. And that's what CRESA does. So CRESA, for the asset manager landscape, there's still not clear guidelines, and they need to figure it out for themselves, what makes sense in their investment process. And it's interesting because our managers are different, and they do this in different ways. But from an investment solutions perspective, so when we evaluate these managers, we want to understand who the guys are that are really good at it. And that's where the proxy voting disclosures come in. For me, to be honest, a proxy voting disclosure doesn't mean much. What I would want to be interested in is where are the engagements happening, the real engagements.
On the real issues that involve,
issues.
you know, the impact on the environment,
Absolutely.
on social factors, and, you know, so on.
Yeah.
Thank you so much for joining us today,
That's
Tracey. All we have time for, that was Tracey Want, Head of Strategic Marketing at Investment Solutions.